So welcome everyone, Stuart here. Today I'm going to go through some of the key measures of the 2026-2027 federal budget and what they mean for you as a founder, SME owner or investor. Now there's some genuinely good news in this budget, but also some real stick in the tail type items that inspire shock and awe. I want to make sure that you're across both sides. So we'll cover three main sections: startups, SMEs and investors. And at the end I'll give you a summary of the key dates you need to keep in mind. So let's get into it. Before we dive into the detail, here's the high-level summary. The green items are the clear wins. So loss carryback is back, and the instant asset write-off is finally permanent after years of annual extensions. The blue items, however, are significant changes that need attention, like the CGT discount is being replaced from July 2027, and the discretionary trust will face a new minimum tax from 2028. The red item, however, is a negative, like the R&D Tax Incentive expenditure threshold increase will cut out a lot of early stage startups out of the R&D program entirely. I'll explain each of these in detail as we go. So let's start with the startups. And there's actually a mix of good and bad news here. I'll cover these three things, like the return of the loss carryback, the R&D tax incentive changes, and what the CGT reform means for founder equity. Now, the loss carryback was introduced during COVID and is now back from July 2026 as a permanent measure. In plain English, if your company made profits in prior years, paid tax on those, and then had a loss year, you can now carry that loss back and get a refund of the tax you now previously paid. It's a real cash flow benefit. The key limitations: it only applies to revenue losses, not capital losses, and the refund is capped by your franking account balance. The second item is loss refundability for new startups. And this is a new measure that only kicks in for companies incorporated from July 2028 onwards. If you're already operating, this one doesn't apply to you. But if you're thinking about starting something new down the track, it's worth knowing about. The R&D tax incentive changes are, however, a mixed bag. Generally good news for growth stage companies, but it can be a real downer for early stage claimants. The good news: the refundable offset threshold goes up from 20 million to 50 million in turnover, meaning growing companies hold on to the better rate for longer. And offset rates for core R&D activities are going up by 25 to 50%. The bad news is that the minimum expenditure threshold is going from 20,000 to 50,000. So if your R&D spend is currently between 20k and 49k, you'll lose eligibility entirely when this kicks in from July of 2028. The bad news is that the minimum expenditure threshold is going up from 20k to 50k. So if your R&D spend is currently between 20 to 49k, you'll lose eligibility entirely when this kicks in from 1st of July 2028. If that's you, the time to act is now. Document your R&D activities thoroughly before 2029 and have a conversation with us about your options. The CGT reform is mostly an investor story, but it has a specific startup angle that's worth calling out. The problem is that the new inflation index model interacts awkwardly with ESS equity and VC-backed exits. High growth assets, exactly the kind that startups produce, will generally do worse under indexation than under the current 50% discount, mainly because the gains are driven by business growth, not inflation. The government has heard this and has announced a formal consultation on how the new CGT rules will interact with startup equity. Now that's positive development, but it means the interaction is on their radar. My advice: if you have unvested options, or approaching a capital raise, or thinking about an exit in the next few years, talk to us now. The rules aren't final yet, and there may be structuring decisions that you can make while the window is still open. The good news for small business owners: this section is mostly wins. Three measures that will make a real difference. The first is that the instant asset write-off is being made permanent, so it's a big deal. We've been managing the uncertainty of annual extensions for years. Now it's locked in. So businesses with turnover of under 10 million can immediately deduct assets under 20k. So if you've been delaying a purchase, you can no longer blame it on tax timing. The second is that the loss carryback rules apply here too. And it's not just for startups. If your business had a profitable prior year, it is now in a loss position, you can carry that loss back and generate a cash refund. Talk to us about whether that applies to you. The third point is that there's a now $1,000 instant work-related deduction. And it's mostly a personal tax measure, but it simplifies things for your team and reduces the paper trail burden for work-related expenses. This is probably the most significant section for many of you. The investor changes are the biggest shift in investment tax settings since 1999. And I'll cover 4 things: the CGT reform itself, what it means for business exits, the discretionary trust changes, and the expanded VC incentives. So this is the headline change from this budget. So basically the 50% CGT discount is being replaced. The good news is that the transition rules are generous. So if you already own assets like shares, investment property, business interests that you acquired before budget night on the 12th of May 2026, you are protected. The existing 50% discount applies to you. This applies even to assets bought between budget night and the 30th of June 2027. They'll still get the 50% discount. The change only applies to assets acquired from 1st of July 2027 onwards. And then for that point, gains will now be calculated on an inflation indexed basis. It is now a new 30% minimum tax rate. For assets that grow in line with inflation, this is roughly comparable. But for high growth assets like startup equity, business goodwill, growth shares, the indexation model will produce a higher tax bill, more likely than the 50% discount. Now, this is a definite planning conversation that we need to have with anyone considering new investments or acquisitions or exits from mid-2027 onwards. Now, there's 2 important items for business owners planning exits or holding assets through family trusts. The first is that there are 4 small business CGT concessions. They're completely untouched, thankfully, like the 15-year exemption, the 50% active asset reduction, the retirement exemption, and the rollover. They're all still there. For most of our clients selling a business, these do the heavy lifting, and this is reassuring news. However, and this is important, the 50% general CGT discount has historically been the first layer of relief that sits below those concessions. For exits that are above the small business thresholds or where the concessions only partially apply, the removal of that first layer will make a real difference. However, and this is important, the 50% general CGT discount has historically been the first layer of relief that sits below those concessions. For exits that are above the small business thresholds, or where the concessions only partially apply, the removal of that first layer will make a real difference to the tax bill from July 2027 onwards. So if you're thinking about selling in the next 2 to 3 years, get in touch with us now so we can model your position. Second big point is around the discretionary trust minimum tax. So from the 1st of July 2028, family trusts will now face a 30% minimum tax on income. Now, this is a significant change for anyone holding investments or business assets in a trust structure. The government has allowed a 3-year rollover window from July 2027 for those who don't want to restructure. But that window won't stay open forever. If you have a trust, we need to be having a conversation soon. 2 more investor items, one positive and one that needs more context. On the VC side, the government has increased the caps under both the VCLP and the ESVCLP programs, which is a clear positive signal for the innovation ecosystem. Super funds are specifically called out as a target beneficiary. This is about getting more institutional capital into Australian startups. So if you're investing through a VC structure, it's worth reviewing with your fund manager. On negative gearing, this is probably the most politically sensitive measure in the budget. So from the 1st of July 2027, negative gearing on residential property will only apply to new builds. But the crucial point, existing property holdings owned at budget night on the 12th of May 2026 are completely grandfathered. So if you already own investment property today, you're not really affected. The impact is on future investment decisions. So if you're considering buying an established investment property after July 2027, the tax maths changes. So new builds remain fully deductible. This is also intended to stimulate new housing supply. So let me put all that into some perspective for the key dates you need to have in your diary. So 1st of July 2026, this is coming up very soon. Carryback measures go live. The instant asset write-off is permanent, and the new $1,000 instant deduction applies from this income year. From 1st of July 2027, this is the big one for investors. So the CGT discount is getting replaced. Negative gearing is limited to new builds. VC caps expand, and most critically, the trust restructure rollover window opens. If you have a discretionary trust, the window to restructure without adverse tax consequences opens from this date. 1st of July 2028, the R&D Tax Incentive minimum threshold increases to 50k. Start losses refundability kicks in for new companies, and the discretionary trust minimum tax of 30% begins. So none of these are fully legislated yet. Detail will emerge over the coming months, but the direction is clear. And early planning is far better than reacting after the fact. So that's the full picture from the 2026-2027 federal budget for now. To summarise, there are genuine wins here, particularly for SMEs and growth stage companies. But the CGT reform, the trust minimum tax and the R&D tax incentive threshold change are significant items that require proactive planning, not a wait and see approach. So none of these changes are fully legislated yet. That's actually a reason to act earlier, not later, because these rules could actually still shift. So if any of this has raised questions about your specific situation, please reach out. We're more than happy to help. Just book a call with us at fullstack.com.au, email the team, or call us directly. Thank you for your time today.